Brad Williams, Frugal Finance, understanding catastrophe bonds or cat bonds. A catastrophe bond, cat bond, is a type of high-yield debt security that helps insurance companies transfer financial risk from natural disasters to investors. If a covered catastrophe, such as a hurricane, earthquake, or wildfire, occurs, the insurer receives a payout from the bond's proceeds, potentially reducing or eliminating investor principal. How cat bonds work? When an insurance or a reinsurance company issues a cat bond, investors purchase it, and the funds are held in a secure collateral account. Investors receive regular interest payments over the bond's life. If no disaster occurs during the bond's term, investors get their full principal back at maturity. However, if the specified event happens and the insurer incurs losses beyond a set threshold, some or all of the principal is used to cover the damages, resulting in a loss for investors. Benefits of cat bonds? Higher yields. Cat bonds offer more attractive interest rates than traditional fixed income securities. Diversification? Since natural disasters are unrelated to stock market movements, cat bonds help hedge against market downturns. Short maturities? Most cat bonds mature within 3 to 5 years, reducing long-term risk exposure. Liquidity for insurers? Cat bonds provide insurance companies with immediate funds, lowering their financial burdens in disaster scenarios. Risk of cat bonds? Principal loss? If a covered disaster occurs, investors may lose part or all of their initial investment. Correlation with economic downturns? While typically uncorrelated with financial markets, a severe disaster could trigger economic disruption, impacting investors. Increasing disaster frequency, climate change, and rising natural catastrophe costs may make payouts more frequent, raising the risk of principal loss. Example of a cat bond? Suppose State Farm issues a cat bond with a $1,000 face value, a 6.5% annual interest rate, and a 2-year maturity. An investor purchasing the bond earns $65 per year in interest. If no disaster occurs, the investor receives their full principal back after 2 years. However, if a hurricane causes $550 million in damages, exceeding the bond's $300 million payout trigger, the bond's principal is used to cover $100 million of the insurer's losses. Investors receive their interest for year 1, but lose their principal in year 2. Final thought? Cat bonds provide an alternative investment opportunity with high yields and market diversification benefits. However, the risk of total loss makes them suitable primarily for institutional investors willing to trade stability for potential high returns. Understanding disaster risk and payout triggers is crucial before investing in these securities. If you have any questions regarding catastrophe bonds, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.